Hello, everyone. It's John Edwards here. Thought I'd get on here and do a quick little market updates video. It's been a while since I've done videos like this, but I'm going to try to do it on a more regular basis. I think it's a great way to communicate. So we've had a good run this year, and the big thing that everyone's talking about is inflation. This past Wednesday, inflation ticked down to 3%, which is very well received by markets. And if we take a look here, we can see the markets are full on rally mode. This looked like it could have been a double top, but this bull breakout that we've had just this last week or so has kind of invalidated that. And just technically on the short term picture, we do expect this rally to continue. There's been 9 other times when the market's been up double digits in the first 6 months of the year. And every single one of those times, the market continued to do very well for the remainder of the year. So we're feeling bullish and we're excited. And we're making a lot of progress on inflation too. Here's the NASDAQ. So tech stocks have led the way. It's no shock to anybody. But those top 7 tech stocks can seem to grow their earnings in just about any environment. And they are up. The NASDAQ, which has more than just the tech stocks, but it's up 43% versus the 18% for the S&P. Here's another great stock, Meta. It's up 150% this year. So a lot of stocks are kind of bottoming at different times. Meta, for instance, bottomed in November, but everything's really turning around. So turning to inflation, as I said, CPI came in at 3% on Wednesday. The biggest contributor to the reduction in inflation is energy, which is also known as oil and oil prices and gasoline. So even though oil prices are going up in the short term right now, this is kind of backwards looking. So it's always important to remember that CPI is a backwards looking indication of inflation. So I like to look at Trueflation over here. It's a more real-time measure of inflation. We can see back, during the middle of the pandemic, earlier, Trueflation was as high as 11%, where the official CPI never made it quite that high. And now it just ticked down from 2.7 something just a day or two to go to 2.11. So I know the Fed is being very cautious, but I think they can go ahead and declare victory. They've made a ton of progress on inflation. Rents are coming down. Used car prices are coming down quickly. And things are definitely moving in the right direction. But they don't want to take any chances, They remember what has happened in the past with previous Feds, and they want to be careful. So yeah, even though technology stocks have led the way, I think there's a lot of opportunity in some other areas, like small caps and real estate. Really, stocks that pay a dividend have been in the doghouse. So anything, that pays a 3%, 4% yield, it's just not attractive when you can get money market at 5%. So really, we see the biggest upside in some of these areas. And anytime we can find something that's in a safe, secure sector that still has a ton of upside, that's really exciting. That's what we look for. So here's a chart of Crown Castle. This is one of the largest cell phone tower companies, and the stock is still down 80% from where it was a year ago. And we all know that cell phone data usage only goes up. So this is a great opportunity. And, this along with data center REITs, which, their clients are companies like those big 7 tech stocks like Google, Apple, and Amazon. So this is one area where we're really excited. The other thing that's been a big buzzword this year that people are talking about is AI, artificial intelligence. This is a real thing. It's going to help companies make a lot more money. and it's not going to take a long time for it to come to fruition. We think by the end of the year, a lot of these companies are going to start to earn more money, and that's part of the reason why tech stocks have performed so well this year. Um, so anyway, back to small caps. This is a cool chart. This shows the price earnings ratio, or how expensive a dollar of earnings from a company is. And we can see up top here, this is large cap stocks, and you can see just over here that they're at about fair value. They're not incredibly expensive, but they're not incredibly cheap either, like they were about a year ago. Mid caps are somewhere in the middle. They're still a better deal. But the true opportunity is in these smaller companies. And if you take a look, you can see it hasn't been very often that the PE ratio on small caps has gotten this low. It did during the pandemic, but before that, it touched down in 2011. Before that, you have to go back to the great financial crisis of 2008, 2009 to see small caps trading at such a discount to large caps. So we're, definitely keeping a strong allocation there. Um, the consensus is that since interest rates are so high, it's hard for these kind of companies to access the debt markets efficiently. So that's kind of the concern. But as we see interest rates come down and the market starts to realize that the rate hike cycle is starting to come to an end, um, these kind of stocks and a lot of other things have a long way to rally. Uh, Finally, let's take a look at the VIX. So the VIX is a measure of volatility, and it's basically measures how expensive stock options, calls, and puts in the next couple of months are in the near term. But it's a really good measure of fear and greed and volatility in the market. The general rule of thumb is that when it's over 20, you have a lot of fear, and it's consistent with a bear market. And when it's below 20, it's more consistent with a bull market. And we've crushed all the way down to 13 here at 29 at this very moment. But you can see a lot of 2022 was spent above 20, as it was a bad year for the markets. But now we're way down here, and the markets are doing well. So anyways, we're excited for what the rest of the year holds. I hope you are too. And thanks for watching. Make it a great day.